In last week's video, we talked about how asset allocations are failing retail investors all over. We showed metrics showing how the stock market did in 2022 during the correction compared to the average retail investor. The average retail investor lost almost 1.5 times as much as the market did as a whole. And the question that we explored in that video was, how can that be the case if asset allocation is supposed to be used as a guide to tell us that we should diversify our portfolio? It reduces risk and it gives us this binary measure, X% in stocks or risk and X% in bonds. It should help us protect our retirement portfolios, and yet it fails at the circumstance that it matters. In last week's video, we talked about the 4 key metrics that I believe are the most important metrics that someone should understand in order to make prudent retirement investing decisions. Those 4 key metrics are beta, stock market correlation, standard deviation, and maximum drawdown. Now, on the screen here at certain points, I'm going to pull up a free tool called Portfolio Visualizer. Portfolio Visualizer will allow you to put in individual investments or portfolios and find out how your portfolio compares to other portfolios, but also what your portfolio's measurement is for these 4 key metrics. In today's video, I'm going to explain the 4 key metrics so you understand them. I think they are simple enough that the average investor can at least understand them at principles level and then use them to make better investment decisions. And as always, if you feel like you haven't got a good enough grasp on these concepts, then you can do some more research online or even reach out to a fee-only financial planner and they can educate you on these concepts. So let's start with beta. Beta is a measure between 0 and 1 that is assigned to your portfolio. And beta tells us how much volatility will your portfolio face using the total stock market, the S&P 500, as a benchmark. To illustrate this with simple numbers, if you have a stock or a bond or a portfolio with a beta of 1, that means that if the S&P 500 goes down 1% that day, your portfolio will follow exactly dollar for dollar, so it will go down 1%. And then a beta above 1 means you'll go down 1 point whatever. So if you have a beta of 1.5 and the S&P 500 goes down 1%, your portfolio will go down 1.5%. A 0.5 beta and your portfolio will go down 0.5% when the S&P 500 goes down 1%. That's what it is. It's very simple. You can put your whole portfolio into Portfolio Visualizer and it'll spit out beta. And I'm going to show a couple example portfolios next week in next week's video, showing the actual betas, the actual investment mix, and how if we had used an asset allocation as the standard guide, we would have been misled, and using beta and these other metrics is a much better method. The second metric we use is stock market correlation. So it's very similar to beta. Stock market correlation tells us directionally where we'll travel. If you have a portfolio with a correlation of 1 to the stock market, it means it will always, in all circumstances, travel in the same direction as the whole stock market. It doesn't tell us the proportion or the amount of change relative to the stock market. That's what beta tells us. So we can use stock market correlation and beta together to get a gauge of, will our portfolio travel both in the same direction as the stock market and at the same magnitude, or maybe at a higher magnitude than the stock market. To tie this back to the asset allocation idea, if we had an asset allocation that resulted in our portfolio going down 37% during the correction in 2022, while the stock market went down 22%, we have an error here, and that error would have been more clear to us if we had known the beta and the correlation of our portfolio. Now, asset allocation tells you nothing about those things, and that is the crux of the problem of relying on asset allocation as a measure of risk or using it for risk management within your portfolio. It's not precise enough to be a reliable tool. When you combine asset allocation with beta and stock market correlation, you have a much clearer idea of where you'll travel compared to the stock market, and then you can kind of manipulate your asset allocation in conjunction with that. Now, the third metric that we use is standard deviation. Standard deviation tells us how wide of a volatility bands could our portfolio move within. I'm not going to explain standard deviation in tons of detail because it does require some statistical knowledge, but we can put a map or an image of standard deviation on the screen. And basically what it says is, if you have a standard deviation of 12%, it means that your portfolio could go up 12% or down 12%. It's somewhere within that 24% range 68% of the time. 2 standard deviations is 95% of the time, and usually those bands get wider. The simple way to use standard deviation is if you want to feel less portfolio volatility, again, thinking back to the principles in the first video, that lower portfolio volatility leads to less impulsive decision-making, which leads to less hesitance, which leads to better confidence, or the inverse, which is less loss of confidence, then standard deviation being smaller will cause less portfolio volatility, or it will be a good indicator that your portfolio will have less portfolio volatility. So a portfolio with a standard deviation of 12% means there's a 24% range within which your portfolio could move. A portfolio with a standard deviation of 8% has a 16% range within which it is likely to move. Standard deviation can be useful to just get a gauge, and it's all based off historical data. And again, you can get that in Portfolio Visualizer. The fourth metric that we use is what's called Max Drawdown. Max Drawdown tells us over a historical period, how deep would the largest loss in that portfolio have been? And then what you can do is compare that portfolio or suggested portfolio against other options and look at which might have had the largest max drawdown or which might have had the smallest. You can use it as a frame of reference, kind of like weighing yourself every day to know how you would feel, or as a way to kind of get a gauge of how you might feel if your portfolio were to have actually had that maximum drawdown. Now, when we combine these four statistics, we learn a few things. We learn directionally, how will our portfolio travel compared to the stock market as a whole? What magnitude will it travel, or what magnitude might it swing compared to the stock market as a whole? Then we also learn what width or range could our portfolio's value fluctuate within a reasonable statistical probability. And then the last thing we learn here is what's the largest loss this portfolio might sustain in over a historical period. Now we can use that data to compare against other portfolios and combine with an asset allocation idea to select the appropriate investments rather than just blindly following an asset allocation. In next week's video, I'm going to substantiate all these metrics by showing 4 model portfolios. I'm going to show a 5-fund Vanguard index fund portfolio, which is a very common boglehead portfolio that can be found on the forums. I'm going to show a second portfolio, which is a 3-fund exchange traded fund portfolio. And then I'm going to show 2 alternative portfolios where we don't use asset allocation as the main guide, but instead we use the 4 metrics I've talked about in conjunction with asset allocation to create what I would consider lower volatility, but more optionality, more flexible portfolios that are also more predictable and with an understanding of the key metrics and the data can calm investors' nerves so that we actually understand and have realistic expectations about how our portfolio will perform. So stay tuned for that video next week. If you haven't already watched last week's video, I highly recommend watching it. You can find the link in the description to this video below. You can also click the card. There's also a previous video I did several months ago called Asset Allocations Are a Scam, where we talk about how bonds and stocks function and how some stocks function like bonds and vice versa, and how that is another misleading factor of an asset allocation as a kind of investment tool. And then if you want some other resources to kind of support all this, you can visit our website and view a sample financial plan. We have a ton of other guides on there, including bucket strategy guides, investment videos, investment risk related videos, and you can find all that on our website at www.thepeakfp.com. To round this video out, please like the video, subscribe to the channel, stay tuned for next week's video so you can get the rest of the story, and please put any comments or suggestions or questions you have in the comments section below this video. And last but not least, if you have any interest, you're more than welcome to schedule a free consultation with our fee-only fiduciary financial planning team on our website at www.thepeakfp.com. Thanks for your time and attention, and see you in the next video.